Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, April the 10th, 2025, recording this in the morning. Okay, so I think yesterday, obviously, I think we all know that Trump, we discovered, I guess we could say we discovered the pain point of Trump, maybe not the equity market. Maybe it's actually the 5% level in the 30-year, in the 30-year bond yields in the US. And we see here that the bond market did touch 5% exactly, and then kind of came down. And of course, that's not necessarily because of Trump, but Trump knows, as an old real estate veteran, remember that Trump's background is real estate deals going back, 45, 50 years, that any time the 30-year yield is higher than 5%, that's terrible for risk assets, obviously for real estate, but in general for risk and assets and the stock market, that is not good. And I think the idea is that there was some kind of discussions, internal and private, between Treasury Secretary Bessent over the weekend down in Florida at Mar-a-Lago on Sunday. And it seems as though Bessent maybe sort of whispered in Trump's ear and said, "Hey, the bond market is becoming dislocated. There is, sort of potential for trades to blow up, the basis trade and whatnot." And that's why Trump was seen come back yesterday. Now, what we did see is a huge sort of a rally, relief rally in risk assets yesterday. So technically, at this point, Trump has given 90 days as a kind of negotiation period for all countries which have not yet imposed retaliatory tariffs. So at that point, that looks like it's sort of Europe, Japan, other countries like that. So that's kind of a positive. On the other hand, yesterday, he of course, did add to the tariffs on China, now in some cases up to 125%, so more than double. It seems that the tariffs of 25% on Mexico and Canada remain in place. So the point is that if we zoom out a little bit, what we have is sort of some kind of negotiating tactic, 90 days. It looks as though there will be some kind of deals done. But the 10% tariffs remain in place, universal 10% tariffs, plus more tariffs on China, plus tariffs on some of America's two biggest trading partners, Mexico and Canada. So the question is that, hey, this is not as bad as it could have been, but this is still net more tariffs, and possibly even more importantly is kind of like uncertainty. Like we have high uncertainty, and that's going to lead to investment decisions being delayed or even put off. So the point is that as long as you have high uncertainty and less investment and less sort of active engagement in the economy, there's low odds, to be honest, of the economy, the real economy, actually sort of expanding. So I think what we might see at this point is a bit of a range over the next, I suppose we could say, 90 days, 3 months. There's going to be a lot of headlines, obviously from Trump, probably every single day. So if that's the case, I mean, let's just have a look at a couple of things here. I mean, clearly, it's pretty interesting to me because, well, let's just look at, let's say, the range case here. So we saw that I'll just use the SPX as a base here. So we saw that ripped up. I mean, I think it was almost like 10%. You see here, ripping up just on the headlines here, 9.75%. So 10% ripping higher. But now the question really is, should this go a lot more? And it seems to me that, some kind of benchmark, we can maybe look at this period of Wednesday, April the 2nd. That's when Trump, if you remember, at 4 p.m. actually started announcing all the tariffs with the big board, the game show board. And so this is where the market, in terms of the SPX, the cash market, kind of started digesting that, which is around about 55.10 or so. So I think, let's call it up about 5,600. I think maybe something like about 5,600. That could be, kind of like the sort of the top of the trading range there. And then maybe something, I don't know, down to about 5,200 or so. So this kind of trading range here, that to me looks around about where we could be in the next kind of couple of weeks. So again, that's the shorter term one. So as I say, 56, maybe something around about 5,650 down to about, say, 5,200. That to me looks like a reasonable little trading range for the next, let's say, couple of weeks in the very short term. But the bigger picture here is that maybe, let's say on the Wednesday, April the 2nd, let's say that's 5,700 going down to about 5,200, something like that. I think, sorry, 4,850, my mistake here. Okay, so I think just to put that into context, that over the next few months, we could get something, something like this kind of box there. And in the shorter term, I think it's going to be about half that, sort of about here, something like that. So at that point, I mean, it's maybe this is an opportunity here to be selling calls, or probably possibly more likely to selling out of the money puts. Probably a similar situation on bonds. The bond market, at this point, it needs more information. We need more data, and we're obviously going to be buffeted by headlines. What is pretty interesting to me, though, is that immediately overnight, if we go back to the futures here, you can see that the ES got to that level at about 5,500, and immediately, sort of once it got there after that initial pop, has sort of sold off a little bit. Similar kind of situation here with the Nasdaq. And if we look at other assets, let's just look at, for example, let's say, for example, crude oil. Crude oil had a nice sort of pop, but immediately giving back $2 or $3. And again, what this is telling us is not a great deal of confidence in the everything is okay, clear sailing ahead. I think the market understands that this is incredible volatility, very difficult to hold any positions, or indeed from a real economy perspective, to be making any kind of significant investment decisions. So the market is going to be very skittish. And this is telling me, that as soon as we get an opportunity to sell, people are taking that as an opportunity rather than, holding. We also see in the currencies, pretty interesting what's going on here. If we look at something like the Swiss franc, we can see that it had been, in a strong position. This is USD Swiss franc. So we see here the US dollar falling against the Swiss franc, had a bit of a pop yesterday, and then immediately you see in the last, I don't know, 6 or 7, 8 hours has come down pretty hard. Similar kind of situation if we look at the JPY, the Japanese yen. The US dollar had a pop yesterday initially just for a few hours, and is sort of selling off again. And you've got to say, could that be getting down towards the 144 and even going down all the way back down to 140? So I think the yen, I can't see any sort of particular reason for the yen to actually fail unless Trump decides suddenly miraculously to take off all tariffs. And I repeat, there are still an extra 10% tariffs globally, plus China, plus Mexico, plus Canada. So the point is that I think the safe haven currency is doing well here. So we see the Swiss and the yen. Again, if we look at some of the risk currencies, for example, let's say look at the Australian dollar here. This is on the spot, so AUD versus USD, doing pretty well. That's interesting that it hasn't sold off. That's interesting. So maybe there's a sense here that a bit of relief on China. I'm curious to monitor that, because I would have expected that to have sold off just as the safe haven currencies were doing better. If we look at New Zealand dollar, that's also doing quite well. Okay, so that looks as though the Antipodean currencies are doing quite well. And if that's the case, we can look here at Canada, which actually is doing okay. So it looks as though the commodity currencies are doing quite well. And that's really interesting for me, because there's a bit of a disconnect here between some of the commodities themselves and the commodity currencies. And maybe that's a function of lack of trust in the US dollar, because if we look at something like copper, which is obviously the classic in terms of risk, we can see that copper had a pop yesterday, but it's come off a little bit. Well, maybe not so much. Okay. So that's, sorry, that's BTC. Oh my God. Here's copper. Yeah, that's what I wanted to show you. So you see here, copper has actually come off. So you see copper had a pretty vicious pop yesterday and is coming back. So the only things which are hanging in there in terms of the risk assets, we do have the Australian dollar and the New Zealand dollar and a little bit the Canadian dollar. Everything else seems to be sort of going a little bit more risk off again. We see that gold continues to power higher. It looks as though it wants to retest the recent highs. Silver's interesting one, because that's sort of, a little bit of a safe haven in a certain sense, but also about 55% of silver usage is for industrial production. And so it's quite sensitive to the industrial cycle and, of course, risk sentiment. And we can see that, again, silver just sort of coming off a little bit, not as much as copper, but in the middle. So definitely still nerves. And if we look at the VIX, we see the VIX came down a lot, as did everything, but we're just interesting to see. So this is the live pricing. You can see the VIX spot here trading at about 36.5, which is very, very elevated. That is imputing like a 2.5% move on the day. But if we look at that compared to 1 day ago, and we can see that at the VIX. Hold on, this is a bit weird. Hold on, let's put it a bit later here. You can see, hold on, this is, sorry, guys, I'm not going to show that because yesterday it was much, much higher. It was much, much higher up in the 50s. There's something wrong with the data, but it's come down a lot if we consider that. So the thing is, the VIX is still elevated. It has come down a little bit. So it's still a good opportunity to be selling volatility if that seems like a good trade, because you're still getting quite good value. What the market's probably going to be looking at as well, apart from the data, which we're going to look at in a second, is just what the Fed is going to do. Because the Fed now, there was a lot of talk, some people saying, oh my God, they're going to have to come in and do an emergency 50 basis point cut and whatnot. But I think all of that pressure is off for the Fed at the moment because, the bond yields, the 5-year, the 30-year yield has come down a little bit. So that's less pressure for the Fed. Also, the stock market has rallied. So, in theory, that's kind of good for the Fed. And just generally, we seem to have potentially a bit more calm in the markets and also in the whole negotiations for tariffs. So the Fed, I think, can take a pause now and go back just to looking at the data and employment. And you see here, this is reflected just in the what the market is pricing in for December by the end of the year. And as you can see, it's just been nothing but a roller coaster. I mean, we're going up and down, 20, 30 basis points every single day. Incredible volatility. And you can see the latest one is that, just before Trump's tweet, the market had been pricing in 110 basis points. So basically over 4 cuts, about 4.2 cuts or so. But as you can see, immediately the market took out a whole cut. But again, now just sort of drifting downwards a little bit. So as we stand at 85 basis points, you can see for December, that equates to about 3.5 cuts. That's probably sounds about right, but it looks as though the market is going to be trading, on Trump tariffs, any sort of sign again. Yeah, the headlines are going to take us up and down. What the market might start looking at again, though, is some of the data. And it's interesting data this morning. We do have, in about an hour, we have CPI. Again, expected, I think the unrounded 0.26 for the core number. From memory, I was looking at some stuff this morning. I think it's 0.26 for the unrounded number, which rounds up to consensus of 0.3. Month over month, only 0.1. So that's a positive for the headline, but the core number 0.3. So really want the market be interesting here to see what happens here in the market reaction. If that comes in lower than expected, will the market start again to price in a more neutral Fed or not? What also is going to be quite interesting is average hourly earnings. Let's keep an eye on those. But probably the initial jobless claims, because that's a weekly number, as we know, relatively timely. And now that, maybe the market will take a pause for a day or two from, the incessant Trump headlines on tariffs. Maybe the market will go back with its focus to looking at the real economy and just saying, hey, how's the real economy doing? So let's keep an eye on the initial jobless claims. Again, expected to be, 220, 225, still very, very good. No problems there. So let's keep an eye on that. So that's about it for the day, guys. I'm going to leave it there. Just curious to see how those risk assets, things like the Aussie dollar, let's see if oil continues to fall, if copper continues to fall, if the stocks continue to fall. Let's see if the bonds have a little bit more of a recovery. Personally, I'll be keeping an eye on also, some of those I just want to talk about Europe as well, because we saw a little bit of a pop in the European bonds just very quickly here. And if I can just bring that up, but keep in mind that European bonds, I mean, the real yield there, if we look at something like, here we go. So let's have a look at, let's say, Germany. You see the German Bund has gone up. We see the Italian BTPs have gone up, and we see the French OATs have all gone up. So, everyone's sort of happy and going, yay. But if I just look at the situation here of the Bund, and I'll maybe look more on the yield, if I can find the German 10-year yield, keep in mind that these yields were very, very elevated, on the back of a reflationary kind of vibe over in Germany and Europe in a sense. And look at the 30-year yield had been up to 3.2. But if you look at something like the German yield, 10-year yield, 2.7, the real yield is not much. If you say that inflation is maybe, I don't know, 2.25%, your real return is only 50, 75 basis points over in Europe. So that's not very attractive in terms of for bondholders. So the real yield is low. Now, the other thing as well, if Trump is less, aggressive or damaging for the economy with his tariffs, could one argue that actually that's a bit of a positive for sort of risk sentiment and the real economy in Europe? Now, if we have a real economy in Europe which is expanding, you could argue that the bond yields need to start going up in Germany, especially again, because they are doing this sort of infrastructure spending and fiscal reflation, which will filter over to the rest of Europe. So interesting just to look here that how the German bond yields have gone down here, and at some point that could be interesting as a short in terms of the price. So basically playing for the for the yields to go upwards. And it could also be a situation here in terms of the yield curve here, just looking at the German yield curve here, which has sort of flattened a little bit. Could that sort of go up a little bit more? We shall see. Keeping an eye on that for Europe. Okay, guys, I'm going to leave it there. CPI and initial jobless claims in about 40 minutes. Let's see how that goes. So thanks very much. Hope that was useful. Keep on talking.